In this lecture, we look at the application of U.S. tax treaties, meaning the way a U.S. tax treaty can influence how a foreign taxpayer is taxed in the United States and who is eligible to use these tax treaties. The objectives of this lecture are to provide a brief overview of U.S. model and bilateral income tax treaties, the relationship between the U.S. taxation of a foreign taxpayer under U.S. tax treaties versus the taxation under U.S. domestic tax law, foreign taxpayers eligible to enjoy the benefits of a U.S. tax treaty, the influence of the U.S. technical explanation on the interpretation of tax treaty provisions, and the influence of the OECD commentaries on the interpretation of tax treaty provisions. Let's start by understanding the nature of U.S. bilateral and model income tax treaties. As of June 2020, the U.S. had bilateral income tax treaties with nearly 60 countries. These treaties covered most of the world's developed countries. However, with only 60 or so treaties, there are many more countries with which the United States does not have treaties than those with which it does. Some of our most important trading partners are countries with which we do not have treaties. For example, the United States does not have treaties with Brazil, Argentina, Chile, or Saudi Arabia. When determining the U.S. tax of a foreign business, it is very important to know if a treaty applies with the foreign taxpayer's country of residence. A bilateral tax treaty is a treaty between the United States and another foreign country. That is, there are just two parties to the treaty. Each such treaty is the result of negotiations between the United States and the other country. Bilateral treaties remain in force until they are revoked or amended. Amendments are infrequent, and some treaties date back to the 1970s and have not been amended. The starting point for negotiating or amending a tax treaty is often the U.S. Model Income Tax Convention, which is itself amended periodically. The current model treaty was issued in 2016, and the one prior to that was issued in 2006. It is important to understand that the issuance of a new model treaty may have no impact on existing U.S. treaties, since existing treaties are amended only as a result of negotiations between the United States and the other countries. Note that in this lecture, we will not refer to any specific bilateral treaty, but will instead refer to the 2016 model treaty. When working on a treaty issue, always refer to the existing bilateral treaty. Let us start with the relationship between U.S. tax treaties and U.S. domestic tax law. The focus is on business income, but the principles apply equally to non-business income. As discussed in Lecture 4-1, under U.S. tax treaties, business income is taxed in the United States only to the extent it is attributable to a permanent establishment in the United States. On the other hand, in Lecture 3-1, we learned that under U.S. domestic tax law, business income is taxed in the United States only to the extent it is effectively connected with the conduct of a U.S. trade or business. Tax treaties are elective. A foreign company does not have to elect to use a tax treaty, but it often pays to do so. Ordinarily, one elects to use a tax treaty only if it will lower U.S. tax. If U.S. tax under a treaty is lower than tax under U.S. domestic tax law, then a foreign person who is eligible for the treaty can elect to use the treaty and pay the lower tax. That is, if the tax on income attributable to a permanent establishment in the United States is less than the tax on income effectively connected with the U.S. trade or business, then the taxpayer elects the treaty and pays the lesser amount. On the other hand, if tax on ECI is less than tax on income attributable to a permanent establishment, a foreign taxpayer can ignore the treaty, once again paying the lesser amount. This means that if used properly, a tax treaty can only lower a foreign taxpayer's U.S. tax. Note that if a foreign taxpayer elects to apply a treaty, all of the provisions of the treaty apply to all of the taxpayer's activities and sources of income. I want to quote now from the 2006 Technical Explanation of the U.S. Model Income Tax Convention on the effect of electing a treaty. In effect, Article 7, Paragraph 2 of the treaty allows the U.S. to tax the lesser of two amounts of income. The amount determined by applying U.S. rules regarding the calculation of effectively connected income, and the amount determined under Article 7 of the Tax Convention. That is, a taxpayer may choose the set of rules that results in the lowest amount of taxable income, but may not mix and match. That is, the taxpayer may not tax some activities under the treaty while taxing others under U.S. law. In some cases, the amount of income attributable to a permanent establishment under Article 7 may be greater than the amount of income that would be treated as effectively connected to a U.S. trade or business under Section 864. For example, a taxpayer that has significant amount of foreign source royalty income attributable to a U.S. branch may find that it will pay less tax in the United States by applying Section 864C of the Code rather than the rules of Article 7 if the foreign source royalties are not derived in the active conduct of a trade or business and thus would not be effectively connected income. But as described in the technical explanation to Article 1, Paragraph 2, if it does so, it may not then use Article 7 principles to exempt other income that would be effectively connected to the U.S. trade or business. Conversely, if it uses Article 7 principles to exempt other effectively connected income that is not attributable to its U.S. permanent establishment, then it must include the foreign source royalties in its net taxable income, even though such royalties would not constitute effectively connected income. To apply a U.S. tax treaty, the foreign taxpayer must be eligible to apply the treaty. With some exceptions, for most provisions of U.S. tax treaties, a taxpayer must be a qualified person, as defined by the Article 22 of the treaty, in order to benefit from those provisions. Note that a qualified person is not the same as a resident. The term resident is important for U.S. treaties, and that term is defined in Article 4 of the U.S. Model Treaty. But to be eligible for many treaty benefits, including the permanent establishment rule, a person needs to be a qualified person, as defined by Article 22. Here's an example. Company A is located in country X, a country with which the United States has a tax treaty. Company A is considered to be engaged in a U.S. trade or business as defined by Section 864 and would ordinarily be taxed on income that is effectively connected with that U.S. trade or business. However, assume that the business activity in the United States is not a permanent establishment as defined by Article 5 of the treaty. By invoking the treaty, Company A can escape U.S. tax. To invoke the treaty, however, Company A must ordinarily be a qualified person under Article 22 of the treaty. When are individuals considered qualified residents of a country so as to be able to enjoy the benefits of that country's treaty with the United States? This question is simple. An individual is a qualified person of the country at the time a treaty benefit is to be accorded to that individual if the person is a resident of the country at that time and is a resident on at least half of the days of any 12-month period that includes the date when the benefit otherwise would be applied and accorded. In general, an individual is a resident of a country when, under the laws of that country, the individual is liable to tax therein solely by reason of his domicile, resident, citizenship, or any other criteria of a similar nature. For example, in 2020, Jones is a citizen of country X, and under the laws of country X, she is liable for country X income taxes on worldwide income merely because she is a citizen of that country. Therefore, she is a resident of country X for purposes of the treaty. In addition, Jones is a citizen of country X for all of 2020. Since she's a resident of country X on at least half of the days of the 12-month period that includes the date when the benefit otherwise would be accorded, she is a qualified person for 2020. It is usually fairly simple to determine if an individual is a qualified person, but not so simple in the case of a business. Different rules apply for public companies and non-public companies. Let us first consider the simple case of a public company with stock that is regularly traded in its country of residence. A public company that is a resident of a country on at least half of the days of any 12-month period that includes the date when the benefit otherwise would be accorded by the treaty is a qualified person of that country if the principal class of its shares is regularly traded on one or more recognized stock exchanges, and any disproportionate class of shares is regularly traded on one or more recognized stock exchanges, and either its principal class of shares is primarily traded on one or more recognized exchanges located in the country of which the company is a resident, or the company's primary place of management and control is the country in which it is a resident. For this purpose, a disproportionate class of shares generally refers to a class of shares that entitles the shareholder disproportionately higher participation in certain earnings. For this purpose, a public company is a resident of a country if, under the laws of that country, it is liable to tax therein by reason of place of management, place of incorporation, or any other criteria of a similar nature. Let's look at an example. In 2020, Company A is a public company incorporated and managed in country X. By reason of both its place of incorporation and place of management, Company A is liable for income tax in country X. Therefore, it is a resident of country X in 2020. In addition, during all of 2020, its principal class of stock is regularly traded on the country X stock exchange. This being the case, Company A is a qualified person of country X. Here's an example of a company that is not a qualified person. In 2020, Company A is a public company incorporated and managed in country X. Its single class of stock is traded on the country X stock exchange, but the stock is not regularly traded on any exchange. Therefore, it is not a qualified person under Article 22(2)(c). However, it may be eligible for treaty benefits under other tests. Here's an example talking about disproportionate shares. Company A is a publicly traded company and a resident of country X. Company A has two classes of shares, common and preferred. The common shares are regularly traded on the principal exchange of country X. The preferred shares are entitled to receive dividends equal in amount to interest payments that Company A receives from unrelated U.S. borrowers. The preferred shares are owned by a single investor that is a resident of a country with which the U.S. does not have a tax treaty. Because that owner is entitled to receive payments corresponding to the U.S. source income earned by Company A, the preferred shares are disproportionate shares. Because the preferred shares are not regularly traded, Company A is not a qualified person. Where the qualified person analysis gets difficult is when you start looking at companies that do not meet the requirements of Article 22(2)(c), that is the requirements for publicly traded companies we just discussed. Let's start with subsidiaries of public companies meeting the requirements of Article 22(2)(c). A company treated as a corporation that is a resident of a country on at least half of the days of any 12-month period that includes the date when the benefit otherwise would be accorded is a qualified person of that country if it meets the ownership test and it meets the base erosion test. In general, a company meets the ownership test if at least 50% of the aggregate vote and value of its shares and any disproportionate shares is owned directly or indirectly by 5 or fewer Article 22(2)(c) companies, that is, public companies that are qualified persons. In general, a company meets the base erosion test if less than 50% of the company's gross income is paid or accrued, directly or indirectly, in the form of base erosion payments, which are payments that are deductible in the company's country of residence to persons not eligible for benefit under the treaty, persons that are connected with the company making the deductible payment and who benefit from a special tax regime with respect to the payment, certain persons that are connected to the company and that receive certain interest payments. Such payments do not include, however, arm's length payments in the ordinary course of business for services or tangible property, and in the case of a tested group, do not include intra-group transactions. Here's an example of the ownership test. Company S is a resident of country X. All of its shares are owned by Company P, that is a resident of country X. Company P is a qualified person under Article 22(2)(c). Therefore, Company S meets the requirements of the ownership test. However, if Company P were a resident of a third state and not a resident of the U.S. or country X, the test would not be met. We now turn to corporate and non-corporate business entities other than individuals. A person other than an individual that is a resident of a country on at least half of the days of any 12-month period that includes the date when the benefits otherwise would be accorded is a qualified person of a country if it meets the ownership test and the base erosion test. In general, a person other than an individual meets the ownership test if qualified persons own at least 50% of the person, that is, the business entity, being tested. And in general, a person other than an individual meets the base erosion test if less than 50% of its gross income is paid in the form of base erosion payments discussed earlier. A taxpayer that is not a qualified person under Article 22 can still enjoy benefits of a treaty in some cases. Article 22 generally limits many treaty benefits to qualified persons. However, under the following rules, it also apportions benefits to taxpayers who are not qualified persons. The active trader business rule, the 95% ownership rule, the headquarters rule, and the competent authority rule. Under the active trader business rule, even though not a qualified person, a resident of a treaty country can enjoy the benefits of the treaty with respect to an item of income derived from the other treaty country. If the resident is engaged in an active conduct of a trade or business in the resident country, and the income derived from the other country emanates from or is incidental to that trade or business. Under the 95% ownership test, a company that is not a qualified resident and that is a resident of a country is entitled to treaty benefits if at the time when the benefit would be accorded and on at least half of the days of a 12-month period commencing or ending on the date when the benefit otherwise would be accorded, meets the 95% ownership test and the base erosion test. Under the 95% ownership test, 95% of the aggregate value and vote of its shares, and at least 50% of any disproportionate class of shares, is owned, directly or indirectly, by 7 or fewer persons who are specified in the treaty. Under the base erosion test, the entity must meet the same type of base erosion tests discussed earlier. Under the headquarters rule, a company that is not a qualified resident can enjoy some treaty benefits if it is a resident of the country, and the company functions as a headquarters company for a multinational corporate group consisting of such company and its direct and indirect subsidiaries. Treaty benefits are limited to those relating to dividends and interest paid by members of its multinational corporate group. Failing all other tests for treaty eligibility, a resident of a country can appeal to the competent authority of the other country with respect to a specific item of income, but only if the resident can show a non-tax nexus to its country of residence, and its residence and operation in the resident country is not for the principal purpose of gaining treaty benefits. Let's move on to the technical explanation of the U.S. Model Income Tax Convention. Treaty interpretation is a vast subject, and this lecture only scratches the surface. This lecture is primarily to sensitize the student to the types of issues that can arise in determining whether a particular treaty applies and how to go about interpreting the treaty. One of the great aids in interpreting U.S. tax treaties is the technical explanation of the U.S. model issued in 2006. We do not have a 2016 technical explanation of the U.S. Model Treaty, so in this lecture, we will refer to the 2006 technical explanation. The parts of the 2016 U.S. Model Treaty that we will be examining are not far different from 2006, so the 2006 explanation is still relevant. The technical explanation discusses each article of the U.S. model in depth. It provides examples of the application of the rules set out in the model. While out of date, the 2006 technical explanation remains a valuable interpretation tool since most of the 2006 U.S. Model Treaty is carried over into the 2016 model without substantial change. In addition, most of the current bilateral treaties are based on the 2006 and earlier model treaties. Let us finish this lecture with a brief discussion of the OECD commentaries on the OECD Tax Convention. The U.S. Model Income Tax Convention and related technical explanation have their parallels in the OECD Model Tax Convention and related commentaries. The current model and commentaries are from 2017. The OECD model has no force of law in any country, but instead forms the basis for most of the treaties written by members of the OECD, that is the Organization of Economic Cooperation and Development. Indeed, the OECD model influences, sometimes strongly, most of the treaties of the world. The OECD model influences the drafting of the US model, for instance. An important aid in interpreting the OECD model is the related commentaries. Unlike our US model, issued in 2016, and the technical explanation issued in 2006, the OECD model and commentaries were issued at the same time in 2017. The commentaries can be quite useful in interpreting U.S. tax treaties. This is because many provisions in the U.S. treaties are substantially the same as those in the OECD model, which the commentaries explain. The OECD model is similar to the U.S. model. The similarity is due to the fact that the U.S. model is based in part on the OECD model. The OECD model is generally agreed upon by members of the OECD, of which the US is one, and serves the purpose of guiding OECD members in drafting their own treaties and related domestic laws so that the developed countries of the world are more or less in agreement with each other on taxation of cross-border transactions. Most tax treaties, including many U.S. tax treaties, are based on, or at least very similar to, the OECD model. So their interpretation may be influenced by the commentaries. The authority of the guidance in the commentaries in interpreting a particular U.S. treaty clause is not certain unless such guidance has been incorporated into a treaty. While the commentaries may provide guidance on the way to interpret a treaty provision, the commentaries are merely soft tax law in that they do not apply directly to any treaty other than perhaps the OECD model, but may be implemented in a country's domestic tax rules legislatively, administratively, or judicially. The lack of clear authority of the commentaries can be inferred from the fact that the same tax provision based on the OECD model and present in different treaties may be interpreted differently by the courts in different countries. Still, the commentaries are a significant source of guidance for both taxpayer, tax administrators, and courts. According to the OECD, taxpayers make extensive use of the commentaries in conducting their businesses and planning their business transactions and investments.